Hello everyone, welcome to the latest IFSL Brunsdon market update. I hope that you all continue to keep safe and well in these very unusual circumstances. Once again, I have with me Jonathan Webster-Smith from Macdonald, who will be answering a few topical questions. Good morning, Jonathan.
Good morning, Brian.
Jonathan, the USA and China seemingly have a deterioration in relationships. What impact do you see that this will have on the markets going forward?
Well, I think, Brian, we sort of have to go back. If we go back before the crisis, what was some of the things that we were talking about and was dominating the market? It was around the US and the China trade deal. You have to remember that 75% of global GDP is controlled by the two economies. So although we're in the middle of a different crisis, there is concern when the market, when we see the US effectively having pops at China quite publicly. It is a concern. President Trump is, I believe, going to say in the next couple of weeks whether China is adhering to that phase one of the trade deal. And we shouldn't forget, obviously, there's a US election coming up. In the last election, he obviously played quite tough around China. And again, that could be quite, he said, well, when you factor in that we're in the middle of this crisis, it could have an impact again. So to get out this crisis, we really need China, a massive exporter, to get global supply chains back. So we could really do with positive comments coming out of the US and China, I think.
Okay, thank you for that. Next question, the market data globally is starting to come out. What is your take on this and how do you see markets reacting?
Well, I mean, the market's been very resilient, but I'll come on to why. I mean, if you look at the data itself, I mean, it was yesterday or this morning, German production was down 9, France down 16, the Bank of England this morning saying it's going to be, sort of the deepest recession in the UK. So there's enough very bad data out there, or as bad as we've ever seen it. We should also factor in that there's going to be a consequence to unemployment. It's not something we've had to deal with in the last few years, but I think sort of longer term unemployment or larger unemployment issues are going to be an issue. The market itself, though, has been incredibly resilient. We had obviously an incredibly negative market in March, and the government stepped in, and the central banks and government both stepped in, to try to save jobs in the short term, and also to push liquidity back into the market. And really, that's what I think the market is focusing on, that the government and central banks are still there doing what they can to ensure normal activity goes on in the markets. And we shouldn't forget that the cost of capital is incredibly cheap at the moment. So people are very much perhaps seeing this as a health and are being a bit more patient, not expecting returns until we get back to work. So whilst the data is dire, the Bank of England did point to a recovery next year, so 14% contraction this year with a 15% gain next year. So at the moment the market is hanging on to the sharper bounce back maybe towards the end of the year or early part of next year.
Thank you, Jonathan. We shall cut in their dividend. Where can clients expect to see income from in the future?
Well, that's I mean, if we again probably start look back. If you look at last year, the FTSE 100 it's always been quite a skewed index for income. So I think last year 4 companies accounted for around 32% of the dividend: BP, Shell, Rios, and BHP. I mean, being sort of 50% of those, Shell and BP, we are seeing dividend cuts. I think 20, 30 other companies have also cut the dividend. So we would expect that the end of the year dividend yield on something like the main indices would be about 50% of what it was, because of the concentration that you see. Is it going to recover quickly? Cash companies that are cash generative, we would expect probably to restart dividends quicker, as you'd expect. So companies generally have cut the dividend through cash flow because they simply don't have the cash flow because of the issues, or for prudence. Those that have done it for prudence, you'd expect to come back faster. So we would expect some dividend growth next year from what will be a very low point this year, we expect. But again, in terms of investor income is a part of how to get a return, and it's important when you're talking to clients. Actually, if you can actually create a capital growth and looking for more growth orientated stocks and take the profit out of those growth as and when it comes, it all comes to a total return. Ultimately, if you get capital growth or income, it's money back to an investor's pocket. So I think rather than looking at the traditional just income, if that's an approach people did use, I think people are going to have to look at the capital and income combined approach to total return rather than just focusing around income. So I think income picks up, but I think it could be a slow pickup over the next 12 to 18 months.
Okay, thank you, Jonathan, and thank you for watching. As always, if you have any questions, then please be in touch. Until then, stay safe and well.